Welcome, and today, Friday, January 30th, 2026, the global markets basically told two completely different stories. Seriously, you've got one continent celebrating some pretty solid gains, while the other, well, it faced a really steep sell-off. So let's break down what's going on with this great transatlantic divergence.
Okay, let's dive right in and look at the numbers. In the US, it was just a sea of red. Tech stocks in particular took a massive hit. But then you look across the ocean and, wow, European markets were rallying with some really nice gains. It was literally a day of perfect opposites.
So what in the world is behind this pretty dramatic split? That's the big question, right? In this explainer, we're going to dig into a comprehensive institutional analysis to unpack the powerful forces driving today's events. And, maybe even more importantly, we'll see what the data is projecting for the month of February.
All right, let's start with what happened in the United States. What exactly caused this dramatic sell-off and spooked the American markets today?
So as you can see here, the damage was pretty widespread, but it wasn't exactly uniform. I mean, look at the Philadelphia Semiconductor Index, the SOX. It got absolutely hammered, dropping over 4%. That is a huge signal of extreme volatility right in the heart of the tech sector, and of course the Nasdaq wasn't too far behind. The analysis really points to two main things that happened today. Think of it as a 1-2 punch. First, you've got the nomination of Kevin Warsh to be the next Fed chair. The market is already calling this the Warsh shock. And basically, everyone's worried it signals a sharp turn towards higher interest rates. Then, to make things worse, you had new protectionist trade policies thrown into the mix, which just poured gasoline on the fire of investor anxiety.
Now this is where the analysis gets really interesting. It argues that this tech correction isn't just about today's news. Nope. It's actually the result of something called malinvestment. The basic idea here is that for years, super low interest rates, cheap money, pushed a ton of capital into all these speculative tech ventures. And now, well, they're facing a pretty harsh reality check.
And here's the perfect example. Just look at Microsoft. The stock fell 10% today, even though they beat their earnings expectations. So you're probably asking, why the big drop? Well, it's because investors are starting to get skeptical. They're looking at this massive 66% jump in AI spending, and they're not seeing the revenue growth to match. That old, simple story of just spend more to grow more, it's starting to fall apart.
And the fancy quantitative models in this report, they back this all up. They show that this isn't just a one-day blip. There's this key metric for the semiconductor sector that has a really high persistence score. What does that mean in plain English? It means today's volatility has a long memory. The model is actually predicting this turbulence is going to stick around for at least the next 14 trading days. So yeah, this storm is definitely not over yet.
Okay, so that's the pretty gloomy picture in America. Now let's hop across the Atlantic and see the completely different story that was unfolding in Europe, where the mood today was, well, a whole lot better.
And what a stark contrast it is. Unlike the US, pretty much all the major European indices closed in the green. As you can see, Germany's DAX and the wider U.S.Stock 50 were really leading the charge, with both of them gaining almost a full percent. It is the perfect mirror image of what we just saw in the American markets.
So this European resilience didn't just come out of nowhere. It was really built on several pillars of strength. For one, we got better than expected economic data from all over. And a big one was Germany's economy finally getting back to growth. On top of that, you had really strong earnings from industrial giants and some smart, proactive trade policy like a new EU-India deal. That acts as a nice buffer against the exact kind of protectionism that's spooking U.S. investors.
The analysis actually attributes Europe's stability to something economists call inclusive institutions. It's a bit of a fancy term, but it's just a way of saying that Europe's cooperative structures, like the EU itself, are proving to be really effective at handling outside shocks and creating a more stable, predictable place to invest. And today, that structural advantage really paid off.
So here's the crucial takeaway, the big idea. It looks like the US and European economies are in completely opposite cycles right now. The theory is that just as the US tech cycle is hitting its peak and maybe starting to come down, the European industrial cycle is just getting started on its recovery from a low point. They are essentially moving to completely different economic rhythms.
Okay, so that's the story of today. But what does all this divergence mean for the month ahead? Well, the report ran thousands of data simulations to put together a pretty detailed forecast for February.
For the US, the outlook for February is, well, not great. It's bearish to neutral. The analysis is projecting something called a mean reversion. That's just a fancy way of saying things are expected to return to more normal levels after a period of, let's say, overexcitement. Specifically, the model projects the S&P 500 will be testing that 6,845 level as this whole tech reset plays out.
Now, over in Europe, it's a completely different forecast. It's decidedly bullish. The thinking is that the continent is going to continue its upward trend, partly because capital is going to be rotating out of U.S. tech and looking for a new home in European industrials. And the model has a pretty ambitious target for Germany's DAX, 25,250.
And looking over to Asia, the forecast is really bullish for Hong Kong and mainland China, mostly thanks to some powerful stimulus measures happening there. But what's really interesting is that we see a kind of echo of that transatlantic split in Korea. The model actually predicts its main Kospi index will go up, but its tech-heavy KOSDAQ index is expected to fall. Sound familiar? A lot like the NASDAQ. But the single biggest upward move projected anywhere in the world, that's for Hong Kong's Hang Seng Index. The report is targeting a nearly 6% gain just for February, and it's all being fueled by a huge policy change. They're getting rid of debt ratio caps for property developers. That's seen as a massive shot in the arm for the market. Okay, so with all this data pointing in different directions, how is an investor supposed to navigate this kind of environment? Well, based on this whole forecast, the report lays out a very specific quantitative strategy for the month of February. So here it is, the optimal portfolio according to the forecast. You can see right away it's heavily tilted towards European stocks and Asian property. That's a combined 55%. But here's the crucial part. It also carves out 15% for shorting U.S. tech. That's essentially a bet that tech will go down, acting as a hedge against more declines.
And this isn't just a random mix of assets. The strategy is super methodical, with clear rules on how to execute it. For instance, it suggests using any extreme spikes in semiconductor volatility for some quick short-term trades. It also talks about using the euro to hedge against a strong dollar. And maybe most importantly, it says to pay very close attention to any commentary from the Fed to know how to adjust those bets against U.S. tech.
So, if there's one crucial takeaway from all of this, it's that what happened today wasn't just random market noise. The report's core thesis is that we're watching a very structured global rotation of capital in real time. Money is moving away from what it sees as overstretched U.S. tech and is actively seeking out fundamental value in Europe and policy-driven recovery in Asia. You know, this whole scenario perfectly captures an idea from the market historian Ken Fisher. He famously wrote that international markets often waltz out of sync. And today, wow, we saw a perfect example of that, with US and Europe waltzing to completely different tunes. And that really leaves us with one final big question. The report, the data, the models, they all seem to project a clear path of divergence ahead. But in our incredibly interconnected global markets, the key question every investor has to be asking themselves is this: how long can two continents really waltz out of sync?